Dan Hoffer, welcome to the podcast, man. I appreciate you making the time.
Thanks so much, Tom. Appreciate the invite.
Yeah, it's been good. So why don't we start a little bit about how you got to your position today. So today you wrote a fund, and so you can talk a little bit about that. But more, I'm kind of interested in just your journey, right? So you've had kind of an entrepreneur journey, and I think it's kind of, you got a bunch of interesting stops along the way. So why don't we just start from an intro standpoint and give people just a high-level overview of kind of how you ended up here.
Yeah, thanks. So I feel like I've done all sorts of different things in my career. Someone once described me when I was younger as a seeker, and so I just love learning new things and having new experiences and kind of moving around. So I've been a management consultant. I've been a product executive for a number of years at multiple companies, and Todd, that's actually where you and I met.
Right.
Back in the day at Concur.
Yep.
And then I've also been a corp dev professional at a couple companies. And then over the last decade or so, I've been a partner at venture capital firms in Silicon Valley. I've also been a founder and CEO of a global travel website, which was venture backed. And so I've had experience on both sides of the table as an operator, as a founder CEO, and as a venture capitalist.
So what do you think? I mean, is there any theme in that besides curiosity? You've taken multiple roles and multiple dimensions of the whole ecosystem, but is there any theme that basically kind of stitches any of that together?
Well, I love learning and growing, but I also love growing companies. And a key reason that I became a venture capitalist was because I was having a ton of fun as an advisor to venture-backed startups. And that was after I had been founder and CEO of my own company called couchsurfing.com, which is a global travel website. And I learned a lot of lessons as a founder. Couchsurfing, by the way, has raised $25 million from Benchmark Capital and General Catalyst and Menlo Ventures and Point Nine Capital and some other folks. And so we did a number of things right, and candidly I made a bunch of mistakes along the way. And after that experience, I wanted to share my learnings with other founders and help them grow and avoid the mistakes that I had made. And that was a lot of fun for me to be that kind of coach. And so I was taking on these advisor roles while I was working at big companies like Concur, which was publicly traded, and even Symantec, also publicly traded. But my hobby was to work on helping founders. And my wife said to me, well, why don't you just become a full-time advisor? I was like, well, I don't know if I can make a living as a full-time advisor, but it turns out that as a venture capitalist, founders tend to listen to you. Maybe because they just have to, to get your money. But at the same time, it was being a venture capitalist has always been an opportunity for me to contribute and hopefully in a positive and constructive way, always to help these founders grow, both personally and also their companies grow in all the domains and tackling all the challenges that companies face.
I'm curious on just that transition from founder to advisor to VC. What are elements of that you think that you've had to kind of tweak along the way to basically be good at each one of those, right? Because I think the founder role in a lot of cases is a lot more operational. A mentor, guidance is basically looking for areas that are maybe blind spots and helping them scale, or pinch points that they have problems with. And then the VC lens is really a combination of those things, but it's got a much more financial and fiscal bent to it too. So I'm curious on, as you've pivoted through those things, were there things that just worked out easy? Did the skill adaptation kind of come naturally for you?
Yeah. Well, I mean, some of the easy things are sharing your network, right? So over time you build up a network of investors and service providers and good people to work with. So that's always applicable whether you're a founder or an advisor or a VC. But as a VC and as an advisor to multiple companies, you start to develop a pattern recognition engine, and start to see themes and patterns. And so I personally feel that now, having worked with dozens of companies over my lifetime, been on over a dozen boards, that I'm frankly, I just have a more valuable perspective than when I was just getting started and
Sure.
only work with a couple. So at this point, I've seen, for example, one trend that I've observed sometimes is certain profiles of founders really love to build. And you can see it oftentimes in their board decks. what they choose to talk about. They talk about in great detail the products,
Yeah.
and they'll go into the individual costs of individual features, which is not really a board level discussion.
Right. Right.
And I've also seen some of those same founders simply avoid the discussion about revenue and sales pipeline, and so you start to notice these patterns, and you're like, oh, this is a builder kind of founder, and this person, that's great because obviously you need a product in order to have a company, but at the same time you also need a strong sales orientation so that you can have revenue, which you also need to have a company.
Yeah. I think in preparation, we were talking about just maybe your skills in evaluating leaders and decision making. You kind of like hinted at some of this, but is there more of like a philosophy or some guidance on that as you've kind of like accrued all this information? You've seen some of this pattern matching. You've given a good example of somebody who is deep in product, maybe somebody who's not as strong in sales. But is there other kind of trends or other ways that you kind of evaluate founders, especially from the VC perspective?
Yeah, I think the most people have a vision for a product that's what gets them going.
Yeah.
But sometimes some founders are light on their go-to-market capabilities. Sometimes they can imagine a go-to-market path, but then they don't, for example, do the financial analysis around the customer acquisition cost,
Yeah.
because maybe they're small sales, and one person, maybe even the CEO, is pursuing a lot of small sales, but they don't run the numbers to say, okay, well, that's actually not going to cover the cost of the sales at scale. And so there's kind of a go-to-market gap. So there are a bunch of different, kind of patterns and things you look for. Certain obviously CAC LTV ratios are pretty well known within the industry, but also thinking about helping founders think through in detail. What are the what's the cost of your sales force? What sales approach are you taking? How much are you doing directly versus indirectly, via channel sales in some cases? And helping them run that analysis is something that some founders can do, but a lot need some help with.
So one of our philosophies is no black boxes, right? You don't need to be an expert in a lot of these areas, but you do need to have a working knowledge of all of them. And it's interesting because some people will come in and they'll have a super strong technical bent, and getting them to like understand the business becomes a challenge. And then you have other folks that are basically like, I'm a product person, but I'm malleable enough to understand what goes on in dev, and I'm malleable enough to listen to what goes to like what I need to do from a go-to-market standpoint. Any insights on how adaptive or how you help people get more well-rounded when they have a super strong area and they focus on it, but sometimes there's a propensity to kind of overpronate and saying, this is what I'm really good at, but yet like my business is going to die if I don't have a strong go-to-market strategy.
Yeah. Yeah. Well, one of the sayings that people have in the venture industry, which I'm sure you've heard, is invest for strengths, not for lack of weaknesses. And so it's fine if someone is weak in an area, so long as they are prepared to hire to augment the team's capabilities in that area. With my investor hat on, which is a little bit different from my advisor hat, with my investor hat on, I'm looking for people who are really extraordinary in certain areas.
Mm-hmm.
And then the question is, well, are you open to hiring somebody else who's extraordinary in areas where you are not as strong? Hopefully the answer is yes, and if so, then you can build out a quality team overall.
Yeah, I think we're in the Midwest, and so I think a lot of our stuff is pretty capital intensive or pretty capital efficient is what we're trying to get to. And so, we had a guy that basically started a company, and he probably did the first 100 sales calls. Technical founder. It was a technical product, so it kind of felt with a technical sales. But like the growth that he got from understanding those sales engagements to like make the product better, but he also understood basically what he needed to hire for. And so I think pivoting too quickly to just like, I'm going to outsource this and find somebody that's super good in this, I think can be a real mistake early on. And so I don't know if you've seen that too, but like we really caution people from saying, let's until you get some pattern with what you're seeing in the sales cycle, you got to own it. You got to own it when you're small.
Well, the sales role is a particular and specific role, and I agree with you. A lot of founder CEOs look for that VP sales as an early hire, which is typically the wrong move.
Yeah.
Because even if they are weak in sales, and some of them are, especially some of the deep tech folks, um, they the sales conversations are a conduit to insight into the customer. And customer insight is something that is, super valuable and key and foundational. And the CEO should absolutely have that, even if they're not like the ideal salesperson.
Right.
The process of talking with customers and seeing what resonates and what doesn't, and all the nuances of those conversations is absolutely critical. So over time, you can hire for a VP sales, probably, Series A stage would be, I
Yeah.
think, the earliest where that makes sense in most
Yeah.
cases.
Yep.
But in other areas, product or partnerships in some cases, engineering, you can augment your skill sets with a key hire earlier than the Series A.
Yep. Totally agree. So maybe let's pivot a little bit to kind of like angel investment and the roles of advisors and that. I mean, I think I'm kind of curious on. It sounds like you've done some of that. It seems like your fund is actually positioned for kind of pre-revenue in a lot of cases. And so, how do you evaluate some stuff when it's super early, right? I mean, it's a concept. Maybe they got a prototype. In today's day and age, it's super easy to prototype something to at least get the concept across. But what do you really look for to make a decision on that? And what would you encourage people that are starting to raise money? It's a very different environment today, at least in my world, from an angel investment standpoint than it was, when interest rates were almost zero.
Mm-hmm. Yep, yep. And for me, my lens and approach is a bit different as an angel investor and versus a professional VC. I'm a little more risk tolerant with my own money, but I'm also not really actively pursuing angel investments right now.
Yep.
More focused on my fund and potentially some advisory support. But that said, you're absolutely right. When a company is just a couple people and a napkin, the sorts of metrics that you dig into at a Series A stage simply don't exist. It's all about the team and the vision. So at that point, you're evaluating the market and the team effectively, and you can do those things, and so, on the market, you can look at the players in the space, the competitive landscape, and try to figure out how differentiated this offering is likely to be. On the team side, you're looking for people who can scale, ideally, to people who you can imagine running 100+ person company, ideally a 1,000-person company, as if things go well. So I always prefer not to replace the founder if possible.
Right. Yep. What do you look for then, right? I mean, it's like, let's say it's two people, they've never done it before. What are some of the characteristics or some of the insight you get that says this person's probably going to go to scale, right? Because I always look at this and say, at the beginning, you're basically just doing. You're kind of a freak of nature, right? You're create this vision, and you're doing a lot of it, and then you kind of get a couple people, and then maybe you delegate, and then so there's this kind of continuum of kind of leadership growth that happens, but you don't get to see that from the very beginning, right? What you're really trying to get was, can you actually get other people excited about your idea, and can you actually execute on it?
Yeah, yeah, yeah. I think it's there are a few things you look for, and it always helps. I mean, I typically some of my best angel investments have happened when I had started out as an advisor and gotten to know the team over time. And you don't always have the luxury to do that.
Yeah.
But it's a preferred way to operate when you do. So I think tenacity, resilience, and hard work, are all absolutely critical and key, and table stakes, frankly. And obviously, intellect. You've got to have smart people. You've got to have people who can attract talent. That's one of the most important things. So one of the mental checks that I make is how would I want to work for this person? Do I respect this person enough that I could imagine myself as COO reporting to them?
Mm-hmm.
Because if I respect them that much, then probably other people will also respect them that much. They'll be able to build a quality team. And so those are a few of the things that I look for. And then, of course, they need to understand the market deeply. That's the founder market fit concept.
Yeah.
and have a vision for it, and then simultaneously be very committed to their vision, but also receptive enough to feedback that they're willing to pivot and not hold unreasonably to anything. So also showing that kind of intellectual flexibility and adaptability, because things always change.
So what do you think is, with the role of kind of AI and stuff, it seems like, or at least our world, it's being inserted into every step in the startup process, right? From a good standpoint, I think, things that used to take us, 6 months to a year now are starting to get crashed even further. MVPs are coming out in 4 to 6 weeks. And, they're not something that's going to be the Taj Mahal, but it certainly can get you something to understand, get it in front of customers, validate it. And that's getting introduced at almost every step, whether it's marketing, whether it's aspects of sales. And so I'm curious about how this process, maybe from your standpoint and evaluation, has changed. Has the bar gone up about what people are expected to have at that level of kind of angel investment because of the tools are getting easier and lower cost to actually get something out?
Mm-hmm. Well, I think the concept of AI will probably kind of disappear from the public discourse in a few years. Um, and the reason is that I've been around the block long enough at this point that I've seen, as you have, cycles come and go. And so I remember, for example, 15 years ago when mobile phones were getting popular, smartphones, and people were talking about a mobile company, and they were starting a mobile company. And now there's no such thing as a mobile company. It's simply just
Right.
something you do on your product roadmap. And so, likewise, AI. A few years from now, I don't think, for the most part, there will not really be any AI companies anymore, except for the most deep tech kind
Right.
of AI companies. But otherwise, AI will just be everywhere. And so, and as you said, we're starting to see that, and people will not lose their jobs to AI. People will lose their jobs if they become so inefficient because they're not using AI. But ultimately, AI will just be everywhere, as you've said. So I think the AI landscape continues to evolve, but in a way that makes it just totally ubiquitous.
So maybe I'll say something a little bit different and maybe bring it back to the original point. I just think it's a level up, right? Like, and I think what's interesting a little bit, Dan, is it's maybe one of the first technologies that I can think of in my timeline that basically benefits people with experience, right? So the older you are, the more of an enabler it is in a lot of cases, right? Because you understand where to go from here to here. There's all these steps. And what you're doing is you're plugging in all these elements to make sure it actually happens. And so I'm curious, as people are younger and they're starting out with this, do you think that I think that this level up is going to happen with everybody? I mean, I think that's what you're kind of saying. And the people that basically just say, hey, I just want to do a job and I want input and output, those are the people at risk. And so as it goes back to scaling and starting startups, don't you think the people that are starting to grab those and scale it that much quickly? I mean, I think that is the skill that will kind of enable you to have a great career or, continue to be effective in this new environment.
Yeah, absolutely, and the art of prompt engineering, which I think is increasingly important, and by the way, may favor some younger folks who just have the natural aptitude to play with technology in a way that older folks tend to do a little bit less of. That'll be a key skill, but yeah, it's interesting to reflect on the ecosystem of AI agents that are emerging, and how those are going to start to interact both with humans, which is the point, but also with each other.
Yeah.
So you can imagine a bunch of AI bots having long conversations with each other, trying to convince each other of things. And it's a brave new world.
It is. Are you seeing any technology that's, whether it's LangChain or some of these other things that are starting to be almost a workflow and decision making engine? I mean, I think that's where things are going. I haven't seen a lot of people have a lot of success with it. But you feel like in 2025, we have all the tools. We should be headed in that direction.
Yeah, I think things like that are starting to emerge. It's interesting from a startup and investor perspective. How important is something like revenue? Because a lot of these technologies that there's not. It's kind of like in crypto, when you're having digital art that
Yeah.
with a unique digital signature, how is there a ecosystem that truly supports that, or is that kind of a speculative opportunity? And so, how much can you actually build a solid company with revenue and margins based on some of these technologies, or is the ecosystem not quite mature enough yet to accommodate something like that?
So let's keep going on this thread. I know this wasn't kind of on our theme, but I guess we kind of think of a lot of development, at least short-term development, could get commoditized over time. It's getting easier, and you're getting more throughput through engineers, right? So people that are full stack developers, you layer these tools on, they become more efficient. And I think what we're seeing even in the folks that we accept is a lot more verticalization, right? So taking those problems and building applications with deep domain expertise. And I'm curious on, it just seems like the tools are enabling smaller and smaller swaths of problems to go be solved. And if you have that domain expertise, then that is opening up a lot of different aspects. And so it's just crazy to me. Like, we had a guy that we just recently talked to, civil engineer in the construction industry. His firm was tired of getting hit with some of these fines about water runoff from storms around construction sites. And so, their Department of Natural Resources and their contractor, there's laws on the books. They come out and inspect, and then all of a sudden they're giving him fines. And so this guy's got like a whole design of what to go do. And you're like, okay, well, and that's different state by state, right? And he was looking at Minnesota, and he was saying there was 480 municipalities in Minnesota that works. And you're like, cost $10,000? That's pretty interesting. And so I'm just curious if you're seeing more of that, and if you kind of feel like some of the development components of this gets democratized over time as the tools get easier to build simple applications.
Yeah, I think. Well, the term vertical SaaS has been thrown around for many years. Obviously, now it's vertical AI-enabled SaaS,
Yeah.
and in many cases, the degree of differentiation and defensibility for an AI company is driven by the data, the training data that it uses, and the access to data that the company has. That's arguably an increasingly important form of defensibility for the entire company, and so. Certainly, taking some broadly trained and applicable AI engines and providing them with particular data that's relevant to particular market niches can create some outsized opportunities.
Yeah. I think I really believe that domain expertise that's not sitting in a horizontal LLM is really the value, right? And so if you can build, vector databases with that in it, do inference training on horizontal, that's maybe an open source model, your cost can come down. You can probably simplify that quite a bit. And really that's where the value, because it probably never gets put into the horizontal LLMs that are, API driven.
Yeah.
And I think, you think about large corporations, whether it's Concur or Semantic or any of these other ones, I think that's the challenge for them over the next 20 years, right? Is like saying, I have all this domain expertise in all these silos. How do I basically do that and then leverage it and then build tools for all the people across my organization to actually do it? And so, that'll be the next 20-year cycle. You're already seeing Accenture and Deloitte do these types of projects, right? They're kind of on the tip of the spear doing it. But I think that is the differentiation where they start to amplify that, and it's just sitting in silos and websites and stuff internally.
Yep. Yeah, I agree with all that. And the one thing they all have in common, and this was really the breakthrough, in some ways the mass market breakthrough of ChatGPT was the language interface, the easily accessible language interface that everybody wants.
Yeah.
For all sorts of use cases now, as the front end. So yes, the power is a combination of that, easy to use front end, ease of use, and combined with the powerful backend integration with proprietary training data sets and proprietary information on how to leverage those data sets to drive business value.
So do you think that OpenAI just becomes more of a consumer brand like Google or somebody? I mean, they've got almost a first mover disadvantage, right? When you think about what happened with DeepSeek or any of these other ones where they're basically, forging the way. It's an expensive process to go do it. And then people can kind of follow, use their model to train. And so, having a consumer brand, seems like, I mean, I prefer Claude. But the number of people that have used Claude in comparison to ChatGPT is huge. Like the drop off is huge. And so I'm curious on how you think some of these large commercial models, is it a good business? And then, the amount of money they're talking about spending from a capital expense. And, there's some questions whether how much incremental, given the, we've talked about ChatGPT 4, 5, and 5, and they're really struggling to get Orion out. Just, is there enough incremental gain for the money we're spending?
Yeah. Well, there's actually a parallel that I've considered with the database industry in the 1990s. And so I realize I'm dating myself here, but
that's all right. You and I are on the same page.
you remember those days?
I do. Yes.
So if you think about Sybase and Informix and Oracle as kind of the corporates, and then MySQL and Postgres and so on. So you see some similar dynamics of these large, expensive corporate platforms, and then open source opportunities as well today. And so if you're a new startup or a new customer of AI, you can choose which platform to use, and some will go for that. Oracle remains a big business. Sybase and Informix, obviously
not so much.
So there is a market opportunity to have that commercial infrastructure and establishment on the AI front, but there's also an opportunity for some of these open source offerings to build the followings, and then of course just like Red Hat Linux, you can build commercial offerings around an open source foundation and so on. So there are many different business models for the ecosystem. With regard to OpenAI specifically, I think obviously there's a lot of brilliant people there, and they're very visionary. So I wouldn't want to speculate on their future, but specifically, but you're right. The costs are astronomical to do what they're doing, and so I think right now we're at an interesting stage in the market evolution where it's still a growth stage. People are not really thinking about margins yet. They're focusing, but they're valuing companies based on top line growth and hype and excitement and things like that. And so OpenAI's opportunity, which I'm sure they're acutely aware of, is to expand beyond just a consumer brand, and obviously they're already building out lots of infrastructure for on the enterprise side, and that already exists. But having private capabilities per enterprise with proprietary training data sets, and making it leverageable across many applications is a big part of their future as well.
Yeah, I'm kind of curious on if you have any thoughts too. I mean, the one thing we haven't been talking a lot about in the industry is just the robotics angle of this, right? Where, I think when you take some of the mechanic robotics that we have today and have that with an AI component of it, lots of things get interesting. There's a power consumption, there's batteries, there's a bunch of constraints that are there. But you would think that, you look at manufacturing, you look at all the different applications, our unemployment rates, like our unemployment rate here is 1.8%, right? And so we don't have enough, we have so many jobs that we just can't find people to go do. And so, there is going to be a replacement strategy with some of that over time. And you'd think that's a huge opportunity for them if they're, they have the right models and solve those problems correctly.
Mm-hmm. Yeah. Yeah. From a business model and investment perspective, it's interesting to think about where robotics makes sense to replace humans, because, for example, at my previous fund, we invested in a startup called Verdant Robotics, which helps with farming and essentially, depending how you look at it, it either replaces farm workers or augments them. Yep. But given some of the farm worker dynamics, many of them are not showing up to work these days.
Yep.
And so there's simply a staffing shortage. And so at that point, it's a great opportunity for robots to come in and help, harvest the crops or spray, pesticides or whatever. And so that's when there's a staffing shortage, robots make sense. The other dynamic is, again, this is kind of from a financial investment perspective, depending on the labor cost of some of these workers, which is not always that high. The robots might cost more than
Yeah.
actually the workers doing it manually. Obviously, I'm talking from a very intellectual perspective, not focusing on the human element, because these are real people with real jobs, and it's a complicated topic to think about replacing humans with robots. But again, with the investment perspective, you think, well, does it actually even make sense for that customer to replace humans with robots? Sometimes it does, sometimes it doesn't. There's a bunch of dynamics around it.
Yeah, and I mean, part of that scale though too, right? The more they produce, the cheaper the per unit becomes, and so then more opportunities look cost effective, right? And so there's just a curve adopting that, and so it just seems like we're still missing some of these elements. You can only do and replace high end ones that basically make sense. And as more of the technology around power, batteries, AI comes together, you would think that there's an opportunity to solve more problems. And with production, the cost comes down over time.
Mm-hmm. Yeah, for sure. Yeah.
It's just interesting. And it just seems like it feels like we're in early innings. And I always kind of joke. I mean, I think I'm 54, and so you think about the evolutions of technology over our lifetime, right? It's like I worked on an Apple IIc. It was my first program. That's what I programmed in BASIC. And I used Fortran 77 in college. And then you think about the internet, and you think about mobile, and then you think about where we are today, and it's like it's a pretty interesting 50-year period.
Sure.
And a lot of change, and it's cool to get to participate at different levels. Really, some of it you knew, some of it you just accidentally stumbled upon, or at least that was my story.
100%. And I also programmed in BASIC on an Apple IIc.
Yeah.
And then an Apple IIe. So I remember
both of those
days as well.
Yeah.
But I think going back to kind of the robot, and it's certainly a fascinating time in the last 50 years. Obviously, the digital revolution is historic in its import. But again, even with robots, I think there's a dynamic of training data as being critical and foundational to make an AI-driven robot successful. So whether it's a Roomba that's getting the lay of the land of your house, or a autonomous forklift driving around your factory trying not to run over people, the data that you give it is makes a huge difference in whether or not it makes sense and will succeed in that.
So you had some. I think you had a fund in mobility. Is that correct? Can't remember.
Yes, I was a managing director at a mobility-focused fund.
Yeah. And so I'm just curious if you have any insight into kind of a lot of the autonomous vehicle discussion, whether it's, Tesla or Waymo, or, there's definitely some competing technology approaches to getting to those. And so and AI plays a huge role in that, right? And so, the self-driving in a Tesla, I've never taken a Waymo ride that's, independent, but those cars are running, I don't know, $200,000, with all of the LiDAR packages and stuff on it. By all accounts, it's a great experience. But, that's not really a commercially available tool for me. But other people, buy a Tesla and they're pretty excited, but that's a totally different approach where it's more software oriented and all the millions of miles that are coming into it. And so I'm just kind of curious from your perspective, if you have any insights or thoughts on, who wins in that model?
Yeah, that's a good question. Who wins in that model? Consumers win in that model eventually.
Yeah.
It's interesting because we're in 2025 right now. We were all supposed to be driving self-driving cars, 5 years ago.
Yep.
And the suite of technical challenges have been much more complex than anyone expected. And some of it is related to there's a whole bunch of things that have inhibited the mass adoption of autonomous technology. Is just one of them. Regulatory is a big one. The patchwork of regulatory framework across the U.S. that determines where autonomous cars can drive and where they can't. In some cases, the connectivity dynamic, because people always thought that 5G was going to be the huge enabler of autonomous driving cars. The problem is 5G does not exist everywhere in the country
Yeah.
or everywhere in the world. And so
Yeah.
if you're an automotive manufacturer, you need to build cars that can drive just as well in, rural Alaska as in,
Yeah.
downtown San Francisco. And so that's been an element as well. I think, in terms of who wins, at scale and eventually, like I said, obviously the consumer wins, but there is certainly a place and room for self-driving cars. There are, of course, the nuances of different levels of self-driving cars, level 1 through 5, and um, as you work up that ladder, it gets more and more complex. But I think the big risk from an investment perspective is, a lot of folks underestimated how difficult it would be, and so they invested into these. Even $1 billion into a startup was woefully inadequate
Yeah.
for self-driving technology. So, I think some of these companies like Waymo, may win the game in terms of market share or technology. In terms of financial returns, it's not clear that they'll make a huge return on the massive amount of money that has been invested into them. So that remains to be seen.
So maybe more pointedly, do you feel like, Waymo's taken like a hardware approach to solving the problem? And, I would say Tesla in particular has gone more software, right? More data, more AI, more processing. And so do you have a thought process on which one of those is better? It seems like in the short term, Waymo's doing pretty well and continue to expand, but it's got a high fixed cost, where, Tesla has a lot of data, it consistently gets better. But the question is, does it get better to the point where you get autonomous 4 or 5, level driving?
Mm-hmm. Well, I think there are many ways to look at it, and you mentioned earlier, the first mover disadvantage in some cases, and especially from a technological perspective. Waymo pioneered the way, and then the risk is that they now have legacy tech in certain areas, and they're now bogged down by that tech debt effectively, and so again, but they're also building the most mature and robust product on the market. So it just depends how you look at it.
Yeah.
So maybe they're winning from the customer experience perspective. Are they going to win, in terms financially or returns to shareholders? Not necessarily.
Yeah.
Tesla has been more gradual in this adoption and kind of self-funding along the way, which is good from a capital perspective. So there are many ways to look at that, the question of who wins. But like I said, ultimately the consumers win because everyone continues to compete to make us all
to get there. So how long do you think this takes? Is it another 5 years? Is it another 7 years? Or no idea?
Well, it's gradual, and my apologies if it seems like I'm kind of nitpicking on the question, but if you're looking to drive in an autonomous car, you can do that today in downtown San Francisco.
Yep.
So in that sense, we're already there. If you want to drive in rural Alaska,
we're a ways away.
We're a ways away.
Yeah.
And then there's the regulatory piece and the technological piece, and then also globally, like I'm not sure if you're talking about just U.S. or globally. So they're just and for example, navigating the streets of India is a very different experience.
Different experience. Yeah.
Google Maps doesn't really work there. There are no addresses in some cases, and there's just a lot of chaos.
Yep.
And which
no lines on the road.
No lines on the road. Yeah. So I think things like that. There are a bunch of corner cases that we don't deal with. So the companies that are pursuing this market have, with the possible exception of China, have been designing it for kind of a U.S. Kind of infrastructure. But obviously, the U.S. is just one of 200 plus countries. So,
yeah.
But the OEMs are thinking from that global perspective. They're trying to make that one car that can operate, as easily, and the Toyota Tacoma can go in the deserts of Egypt or downtown Minneapolis. So the OEMs would prefer to have that one SKU if possible.
Yeah, maybe one more comment on this. It's just interesting. You get into a Tesla and it feels like it was developed around the software and then the hardware. Whereas, a lot of ICE, traditional, Ford, GM, whatever it happens to be, they're basically bolting on software. And so to me, that's the inflection point. I mean, you think of BYD or any of these other ones, I think they're taking a very similar approach. And so, I have some concerns on like some of the tariffs and stuff. If we can drive more innovation to get more closer to that experience over time, it seems like it's the right thing to do from a consumer perspective, versus protecting an industry that maybe has been slow to adopt some of these new technologies. And so it'll be interesting to see. I mean, it's a fascinating space, and there's a lot of evolution to it. But Elon, to his credit, he designed something that is, we haven't had a new car company in 100 years. And so, I mean, I think, whatever you think of him outside of those endeavors, that's still pretty impressive.
Yeah, well, I think definitely, his vision of a software-driven car,
Yeah.
which, as you described, is defined by the software and not the hardware, was revolutionary,
Yep.
and distinctive, and that was, the vision that I think a lot of Tesla's early investors bought into.
Yep.
Because it's not just another car company.
Yep. Okay, let's pivot away from AI and some of this stuff. I appreciate the tangent with me. You've written in the past a little bit about just right sizing kind of capital runway and just kind of understanding your kind of inflection point in your company's kind of evolution, how much money to raise. So maybe talk a little bit about that, because I think that's an interesting one. I think there's a knee-jerk reaction in a lot of entrepreneurs. I just got to go raise more money, raise more money, raise more money. I think sometimes they don't think of dilution. They don't think of, like if it doesn't grow as fast and you've got, all these terms in your term sheet, it can really bite you. And so maybe explain a little bit more about what you think about that from a right sizing of capital in your runway, and just kind of lessons to be learned there.
Yeah. Well, in my experience, founders do tend to think a fair amount about dilution in most cases. Sometimes too much about dilution, because they're trying to maximize their valuation,
Sure.
which is not always the thing that they should be focusing on. It's dangerous to maximize valuation in many cases, even when you can. You shouldn't necessarily, because you're setting yourself up for failure down the road, and a down round, which is unpleasant for everybody.
Yeah.
They say that sophisticated founders will focus more on the terms than the valuation,
Yeah.
and their governance dynamics and things like that.
Yep.
But in terms of the runway optimization, the capital runway, there's this kind of conventional wisdom that you should raise 18 months of capital, and I've always kind of questioned that. And thought to myself, well, why 18 months? What's magical about 18? Sometimes it's 18 to 24, but still these numbers seem arbitrary. And really the point is, obviously founders don't want to give away any more of their company than they have to. And my advice, and I wrote an article for Forbes about this, is to think about where the inflection points of the value drivers are going to occur in the evolution of the business. So if you're if you have a year of runway, and you can close a big sale 6 months in, then at that point, after that 6 months, or maybe a big partnership, or maybe you've landed a key hire, you've recruited Elon to be your chairman or something. Events like that can have a big impact on your valuation, and so that's actually those events should be what drives when you raise money, because at that point your valuation is just going to jump up. Otherwise, your valuation might kind of be flat for a very long time, characterized by a big spike whenever something good happens, or conversely when something bad happens. But it's easier to predict the good things, hopefully, than the bad things. But in either case, you want to think about the trajectory of the business, what's likely to happen, and then try to structure your fundraising around those individual points in time, where a massive change in value is taking place.
So do you think there's enough predictability in a lot of that? I'm sure you're just like I am. We deal with a lot of optimistic investors, right? Or entrepreneurs, right? They basically think they're going to get more green lights than they necessarily do. And so, I think, especially if you're young and you've never done it before, I think that's, you look at this and say, here's a huge TAM that I can go after. I've had some early success. This is just going to go to the moon, and it's hard to talk them out of that. And so I'm kind of curious about, like, how do you do that? Because in theory, it makes really good sense. In practicality, I guess I'm just thinking through a couple of examples that I probably would have struggled with them.
Yeah. Well, so I mean, I agree with you. Life is not predictable, and startup life especially is not predictable, and founders have to be irrationally exuberant and
that's not why they get into it.
Yeah. I mean, no one would be a founder if
they can't change the world. I'm not doing it.
Yeah. So founders are a certain breed of people who are supremely optimistic and self-confident, and you need that. That's necessary, even though it can also kind of get you into trouble. And absolutely, some things are impossible to predict, but some things are possible to predict. And for example, if you're working on a partnership negotiation with a big company, that might be a 6-month negotiating process, or a major sale, or your first pilot, or something like that. And then imagine there's a 2 or 3 month pilot, and then you're expecting that a much larger contract will get signed, after that pilot completes, and you figure that contract will take a month to negotiate. So now you're looking at 4 months, and assuming it goes on track, then you're like, okay, well, at that point, the value of my company is going to spike as soon as that closes. So you can start to time your fundraising around events like that. Also, key hires, if you're recruiting a high profile member of the C-suite, maybe even a CEO, that might also take 6 months. And so things like some things are not predictable, but some of those things I think are predictable.
And so that totally makes a lot of sense. So maybe put it in the context, though. What does that mean for when you raise? So, like, you get to these inflection points. Are you basically raising enough capital to, like, get you to the next one? So if the 18 to 24 months is kind of arbitrary, are you really trying to just fundraise in between these major events with some sort of margin of safety?
Yeah. Yes. I think that's the right way to look at it. And you're basically raising from one inflection point to the next inflection point, however long that might be. Maybe it's 18 months, or maybe it's not. Maybe it's more or less than that. But yes, from one inflection point to the next, and taking into account also that it will probably take 6 months to raise, depending on which round you're looking at and market dynamics and so on. Things that are specific to your company. But yes, you need to take into account that, conservatively say 6 months, just as that margin of safety, so you don't find yourself with your back against the wall.
Yeah, you don't want that. That's not a good spot to be raising capital, that's for sure. Well, good. I mean, we've taken almost 48 minutes out of this. I guess I'd try to wrap it up a little bit and maybe give you an opportunity to talk a little bit about your fund, Deep Venture Partners, and kind of maybe what you guys look for, kind of where you are in the process of what type of maturity you're looking for and the type of projects.
Yeah. So Deep Venture Partners is focused on pre-seed to Series A investments. We have an affinity for deep tech as well as marketplaces and consumer. And we my co-founder of the fund was a former VP of AI at Meta, and the founder of Google Street View, and so and he's got 100 patents. So he's well suited to evaluate AI deals as well as across multiple of industries and verticals, because as we've seen, depending on the training data, AI can be broadly applicable. So overall, and then we also have an advisory board with professors and key scientists from around the world who help us look at deals as well. So right now we're interested in those kinds of sectors, and we're a young fund, but excited at the opportunity, because there's a lot of overlooked potential, we believe, in the university ecosystem, and I personally enjoy investing at an early stage.
Sure.
And some people are better late stage investors. I personally feel like I'm a better earlier stage investor, and that's also happens to be where the most upside is.
Yeah, that's good. Well, if people want to get a hold of you, what's the best way to do that?
Yeah, through my website, deepventurepartners.com,
Okay.
or deepvp.com. They both work. They go to the same place.
Okay.
And my email address is dan@deepvp.com.
Okay, well, good. Well, Dan, I really appreciate you taking the time to do this. This was a fun conversation. We covered a bunch of interesting topics that I think are relevant, and I appreciate you just kind of sharing your wisdom.
Yeah, well, it was a lot of fun to chat about it, and thanks so much for the invite.
Okay, well, sounds good.
Take care.
If you enjoyed the podcast today, please just take a moment to rate it or comment on it for us. This feedback really helps us, and it helps us get the word out to helping other entrepreneurs and founders. Thank you.